we'll talk about some simple economics of flexible exchange rates. Okay, this is perhaps the major part of today's lecture. We'll talk about the simple economics of floating exchange rate mechanism. We'll talk about central banks' rationale for participating in the market. We'll talk about the trilemma. These are all part of this part of the lecture. Okay, so the floating exchange rate regime, at the heart of it is the equilibrium spot exchange rate. So this is where the exchange rates are determined. So there are two forces that determine the price of a foreign currency in terms of a domestic currency, which is the exchange rate, okay, which is the demand for a foreign currency and the supply of a foreign currency. So let us consider the dollar per euro example. In this example, it's a two-country model. Take the USA as the home country and the European Union as the foreign country, for example. So in this example, US dollar is the domestic currency and euro is the foreign currency. Okay. Now, what determines the demand for euro or foreign currency? It is derived from the demand for foreign countries' goods, services, and financial assets. For example, when the Americans demand German goods, for example, Mercedes or BMW autos, they have to pay in euros. Okay, so sitting in the USA, if you want to buy a German-made car, you have to pay in euros. And for this, they have to exchange their dollars for euros. Now, the law of demand, downward sloping demand, which you learned in your principles of economics class, it also applies in the foreign exchange market. The more Americans have to pay in US dollars to buy 1 euro from the foreign exchange market, the less they demand euro. Okay, like any other normal good, the law of demand works in the foreign exchange market, and it has downward sloping demand curve. Okay, so at a higher exchange rate, Americans demand for less euro. As the exchange rate goes down, which means when US dollar gets cheaper against euro, the demand increases. Okay, so in this example, in order to buy 1 euro here at this point, an American citizen needs to spend $1.20. At this point, in order to buy 1 euro, an American needs to spend $1 US. So the value of US dollar is actually increasing. Okay, the US dollar is appreciating, domestic currency is appreciating. In other words, the price per euro is going down. Okay, so when the price per euro goes down, demand for euro increases, okay, like any other normal good. Okay. Other part is the supply of a foreign currency, which is derived from the foreign countries' demand for local goods. For example, when German consumers want to buy US goods, for example, Dell computers, they must convert their euros to US dollar. This increases the supply of euros in USA. Okay, and like any other normal good, it has an upward sloping supply curve. Okay, the more Germans get by selling 1 euro from foreign exchange market, the more they supply euro. Okay, So at higher price of euro, at this point, by selling 1 euro, the people of German, they can get $1.20. So this is their the amount of supply of euro. When they get only $1 for a euro, they sell much less. So the supply curve, the supply of euro in the US is upward sloping, and equilibrium is determined by the intersection of demand and supply. Okay, so this is our simple economics 101 lesson, okay, like any other normal. Now, how do we calculate exchange rates? We talked about these things last week. Let us try to refresh our memory. So appreciation or depreciation of foreign currency against the domestic currency. This is how we determine E1 minus E0 divided by E0. So this is the old dollar value of euro, E0, and E1 is the new dollar value of euro. Okay, this is how we determine whether foreign currency appreciates or depreciates against domestic currency. Okay, here is an example. Say in 2007, the yen went from 0.0084 to 0.0089. Okay, by how much did the yen appreciate against dollar? Okay, so if you look at this example, with 1 yen, you could have bought 0.0084 US dollar. Now you can buy more US dollar, 0.0089. So Japanese yen actually appreciated against US dollar. Okay, and yen is domestic currency in this example. So E0 is the value of yen per dollar in 2006. E1 is the value is yen per dollar in 2007. Appreciation of yen against dollar. Okay, this is how we calculate it. Okay. Now, what are the factors that affect equilibrium exchange rate? Inflation rates, relative interest rates, relative growth rates, and political and economic risk. So relative inflation rate means the relative price levels in the two countries. Okay, what happens when the price level increases in Australia and that remains fixed in the USA? Okay, currency moves from one country to another country. What happens when relative interest rates change? So for example, interest rate increased in the USA, followed by an interest rate increase in the European Union countries. You know that recently US moved first. Among the developed countries, advanced countries, USA increased the interest rate first, and there was a time difference. Very recently, the European Central Bank, it increased its interest rate. So what happened in the meantime? Capital flew from European countries to the USA, because when the Federal Reserve, when the Federal Reserve System increased interest rate in the USA, rate of return from investment increased in the USA. So capital flew from European countries to USA. Okay. And when that happens, the exchange rate changed. How? Because US dollar, the demand for US dollar increased. And when the demand for a currency increases, its value, its price against another currency increases. And this is simply what happened. For the first time in history, US and Euro, they came at par. Okay, so historically, the value of euro was higher than the value of the USA. Okay, but until very recently, they came at par. In other words, US dollar became much stronger against euro, relatively stronger against euro. Okay, uh, so these are the factors which affect equilibrium exchange rate, and we'll talk about. We'll draw several different examples throughout the unit where you can see these examples, how inflation rate, interest rate, economic growth rate, and political risk, they change equilibrium exchange rates. Okay. Excuse me. Expectations also play an important role. Okay, because currency values are forward looking in the sense that they depend on the current demand and supply, as well as what the speculators expect about the future movement. Okay, so arbitrageurs, as I said, I mean, I told you previously that foreign exchange market is the largest market in the world, and there are many speculators who actively participate in the market. So if you expect that US dollar will get much stronger in the future, you may or there are arbitrageurs in the market who are actually purchasing US dollar at the moment with the hope that the US dollar, the value of the US dollar will increase over time. Now, this is a question to you. What do you think? Do you think the US value of US dollar will remain this strong for a long time? Or do you think it will reverse at some point? Okay. So as I said, arbitrageurs, they played an important role in the Asian currency crisis. So what happened? It happened during around 1997. Okay, I told you previously that 1997 is an important year because of the Asian currency crisis. When I was discussing uh, the brief history of interest rate, uh, the international monetary system. Okay, 1997. This is an important threshold year, primarily because of the East Asian currency crisis. Okay, so what happened in East Asia? Excuse me. Okay, yeah. So all the major Asian countries, Asian currencies like Malaysian ringgit, Thai baht, Indonesian rupiah, uh, they were tied to the US dollar. Okay? They were tied to the US dollar. So there was a fixed rate, fixed exchange rate. So sorry, it was not fixed rate, it was a soft peg. Okay. Their values were tied to the US dollar. So the exchange rate between Malaysian ringgit and US dollar, for example, was fixed. But whenever the value of US dollar changed against other currencies, say for example against the pound sterling or against Japanese yen, the value of Malaysian ringgit also changed against British pound sterling or Japanese yen. So what happened around in the mid 1997, excuse me, US dollar appreciated by 50% against the Japanese yen. Now, Japan was the major importer from these Asian countries. Okay. Japan was the major trading partner of these countries. So what happened when US dollar appreciated against Japanese yen? As a result, Malaysian ringgit also appreciated against Japanese yen because Malaysian ringgit was tied to the US dollar. So was Thai baht, Indonesian rupiah. So when US dollar appreciated, Malaysian ringgit and other Asian currencies also appreciated. And as a result, they lost a competitive advantage in the export market. Okay, particularly Chinese yuan. So on the one hand, they their export market shrinked. Okay, export from the Asian countries declined. At the same time, speculators, they expected that the governments would do something. They would do something to devalue their currency. Okay, so what they did, they used their Asian currencies to buy US dollar. Okay? So that when they expected that the government would do something to devalue the currency. So when the Malaysian ringgit or Thai baht, when the value will actually decline, they can sell it to the market. They can sell their US dollar to the market. Okay, so they purchased US dollar with Asian currencies, and they were actually the speculators. Actually, they were right. The Asian countries, the governments of the Asian countries, they devalued their currency. Okay, and when the currency were actually devalued, the speculators, they started selling US dollar against those currencies, which created a further rounds of devaluation. So that created a currency crisis in the East Asian countries. And at that time, IMF, the International Monetary Fund, came up with support to stabilize the currency values of those countries. Okay. So the bottom line here is expectations also play an important role. Okay. To the next slide, I'll talk about central bank's intervention, and then I'll talk about the trilemma or the impossible trinity. Okay. So I'll take a short break and I'll come back. Thank you.